Welcome to today's video on the Backdoor Roth IRA and a subtle trap that can create outsized compliance headaches. In this session, we'll unpack why leaving even a few dollars behind can trigger the Pro Rata Rule and what to do instead. We'll also cover practical steps, a mini example, and a quick quiz to lock in your understanding. Let's begin by briefly reviewing what the Backdoor Roth is and why people use it. The Backdoor Roth is a two-step strategy. First, you make a non-deductible contribution to a traditional IRA, and second, you convert those dollars to a Roth IRA. The reason higher earners use this approach is that direct Roth IRA contributions are limited or phased out at higher incomes, but conversions are allowed regardless of income. With that overview complete, we can now turn to the trap that catches many people: small residual amounts left behind that invoke the Pro Rata Rule. Here's our roadmap. First, we'll explain the trap: how tiny amounts can cause outsized administrative issues. Next, we'll simplify the Pro Rata Rule. Then we'll introduce the solution called Absolute Zero and walk through a step-by-step workflow to execute it. We'll also cover Form 8606 at a high level, run a mini example, and test your knowledge with a short quiz. Finally, we'll summarize the key points. Before we dive deeper, a quick but important disclaimer. This content is for educational purposes only and is not tax, legal, or investment advice. Your situation is unique, and the tax code and forms can change. Please consult a qualified tax professional or financial advisor to evaluate your specific facts and circumstances. With that in mind, let's proceed to understand the exact trap we're trying to avoid. The central trap is leaving small residual earnings, sometimes literally pennies, in a traditional IRA during a backdoor Roth conversion. The Pro Rata Rule aggregates all your non-Roth IRAs as of December 31st and determines what percentage of your conversion is taxable. Even a single dollar of pre-tax funds can force a portion of your conversion to be taxed. While the actual tax may be small, the administrative burden, especially in tracking basis and correctly filing, can be significant. Next, let's define the Pro Rata Rule in plain terms. The Pro Rata Rule looks at the composition of all your non-Roth IRAs on December 31st. It combines balances from traditional, SEP, and simple IRAs. The taxable portion of any conversion is proportional to the pre-tax share of your total IRA dollars. The important insight is that the tax is assessed on pre-tax amounts like earnings or prior deductible contributions, not on your entire after-tax contribution. Therefore, to keep your conversion clean and simple, you want as few pre-tax dollars as possible on December 31st. Ideally none. Now, let's clarify which accounts are counted and which are not. Here's how the December 31st aggregation works. Traditional IRAs, including rollover IRAs, are counted. SEP and simple IRAs are also counted. Roth IRAs are excluded from the aggregation. Employer plans like 401k, 403b, and 457b are not part of the calculation unless you roll them into an IRA before December 31st. Which would then include them. Taxable brokerage accounts are not included. With that foundation set, let's move to the solution that avoids the trap entirely. To avoid the trap, use the Absolute Zero approach. First, make a non-deductible contribution to a traditional IRA. Second, convert to a Roth IRA as soon as the contribution settles. To reduce the chance of generating earnings, avoid parking funds in interest-bearing settlement accounts. If your custodian offers a cash management or sweep option with minimal accrual, prefer that. Third, watch for tiny residual earnings, the dregs, between contribution and conversion. If they appear, convert them too. Fourth, maintain zero balances across all non-Roth IRAs by year-end. Fifth, if you have pre-tax IRA money, consider rolling it into an employer plan, like a 401k, before December 31st, so it is not included in the aggregation. Sixth, if the Pro Rata Rule still applies due to small residual interest, be sure to file Form 8606 to track your basis properly. Finally, document everything: record dates, amounts, and confirmations, and keep statements along with Forms 1099-R and 5498. Next, we'll visualize the timing with a quick timeline diagram. This timeline highlights the ideal sequence. Open or confirm accounts and settlement settings first, then contribute after-tax dollars to the traditional IRA, and convert immediately upon settlement. Shortly thereafter, verify whether any residual earnings appeared and convert them if necessary. Before December 31st, confirm that all non-Roth IRAs have a zero balance. Early in the new year, you'll receive tax forms, including the 1099-R for the conversion, and later the 5498 showing the prior year contribution. At tax time, file Form 8606 correctly to track basis. Now that we understand the timing, let's cover Form 8606 at a high level. Form 8606 is the IRS form used to report non-deductible IRA contributions and Roth conversions and to track your after-tax basis. This is essential for avoiding double taxation. If a small amount of interest accrued before your conversion, only that earnings portion is taxable. Ensure you retain consistent records year over year so that your basis reconciles across filings. With the filing context set, let's test your understanding with a quick quiz. Question: on which accounts and date does the Pro Rata Rule aggregate balances for a backdoor Roth conversion? Options are: A. Only the specific traditional IRA you converted, on the conversion date. B. All your non-Roth IRAs, traditional, SEP, and simple combined, on December 31st. C. Only SEP IRAs on December 31st. D. Balances only on the day you convert, not year-end. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The Pro Rata Rule aggregates all your non-Roth IRAs on December 31st. The taxable portion of your conversion is determined by the pre-tax share of your total IRA balances at that year-end snapshot. Next, let's walk through a quick illustrative example. Consider two cases. Case A. You contribute $6.500 after tax, $5 of interest accrues before you convert, and you hold no other non-Roth IRAs. In that case, the taxable amount is approximately the $5 of earnings. Case B. You also have $20,000 in another pre-tax IRA at year-end. Now the taxable fraction of your conversion increases because the Pro Rata Rule aggregates all non-Roth IRAs on December 31st. The key takeaway is that you should minimize or eliminate outside pre-tax IRA balances before year-end, potentially by rolling them into an eligible employer plan. Next, let's do one more quick quiz to reinforce the absolute zero mindset. Question: you notice $1.04 of interest in your traditional IRA right after your contribution posts. What is the best move to keep your process clean? Options: A. Leave it there to avoid another taxable event. B. Convert the $1.04 immediately. And, if any pre-tax dollars remain at year-end, track them on Form 8606. C. Roll it to a 401k next year. D. Withdraw the $1.04 as a distribution. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Convert the small residual interest immediately. This aligns with the absolute zero strategy, keeping all non-Roth IRA balances at zero by year-end. If pro rata still applies due to timing, only the tiny earnings are taxable, and you will track your non-deductible basis with Form 8606. Now, let's cement the most important takeaways. The key takeaways are as follows. First, convert every last penny and aim for absolute zero. Second, December 31st is the critical aggregation date, so plan your timing accordingly. Third, remember that only gains or other pre-tax dollars are taxed, not your entire after-tax contribution. Fourth, reduce or avoid immediate earnings by using cash-like settlement options. Finally, keep thorough documentation, including Forms 1099-R, 5498, and 8606. Let's wrap up with a short summary. In summary, the backdoor Roth is a useful strategy, but the Pro Rata Rule can turn minor earnings into administrative complexity. The best fix is to maintain absolute zero across all non-Roth IRAs by December 31st. If small gains occur, convert them and file Form 8606 to keep your basis tracking accurate. Plan your timing carefully, minimize immediate earnings, and document all activity. Finally, I have one last quick request before we go. Thanks for watching. If this video helped you avoid a compliance headache, please like the video, share it with a friend who is considering a backdoor Roth, and subscribe for more practical, research-driven financial content. Tell us in the comments how you're planning to maintain absolute zero this year, and what topics you want next.